Hi, we will start with our monthly market outlook. If we look at global inflation, slowly and steadily, it has started coming off in developed world. Partly it is driven by impact of high interest rate on growth, and partly it is supply chain normalization. However, rise in commodity prices from gold, copper, silver, aluminium is all resulting into putting a pressure on inflation. Even supply chain normalization seems to be getting disturbed with geopolitical events. The supply chain disruption in Red Sea could have impact on energy prices. Already it's resulting into cargoes moving over larger distance, resulting into higher freight prices. Will higher commodity price and higher freight prices impact inflation adversely? That's something which we will have to see. One silver lining for rising inflation could be excess capacity in China. China has built humongous industrial capacity, and for years it was manufacturer to the world. Can excess capacity in China keep global inflation under lead? Despite some fears on inflation, globally central banks have started cutting rates. Of course, the big daddy US Fed is keeping rates on hold as they are not seeing requisite slowdown in inflation or requisite removal of tightness in labor market. The markets are pricing in easing cycle or cut in interest rates, but who knows whether that expectations will be met or not. Based on current scenario, a lot of people believe that central banks will pull rabbit out of the hat, and neither there will be recession nor there will be any material impact in terms of stagflation. We will end up into a scenario like no lending, which is subdued growth and subdued inflation. One big of most global counterparts, fiscal deficit in China is staying at elevated level despite COVID getting over. Their non-performing loans continue to climb, and while providing for those non-performing loans, the net interest margin of Chinese banks continue to come down. Right now, Chinese banks' net interest margin is about 1.7, 1.8%. That's reasonably half of most Indian banks. In this kind of scenario, market is at crossroads. Stocks are rising as if Fed has started cutting rates. Bonds are falling as if rate hikes are coming back. Gold prices are rising like we are entering a recession. Oil prices are rising as if there is perfect economy. And crypto is at all-time high, like absolute nothing is happening. In this kind of scenario, which way the markets will move? Coming to US economy, Fed has maintained a delicate balance between growth and inflation. They raised interest rates rapidly, but now they have started withdrawing accommodation or quantitative easing. And from about 4.8 trillion infused into the economy and banking system since COVID, they have already taken out 1.5 trillion. Fed, will it continue to take money out or will it stop to support growth? Will be the question to see. Partly Fed is deferring interest rate as they believe they are not getting enough confidence either from labor market or from inflation to cut interest rates. Maybe somewhere the rebound of inflation in 1970 during Arthur Burns' time is impacting the judgment of Fed. If we look at US economy, their GDP growth is still coming reasonably strong, and inflation is slowly and steadily inching up. This large part of the growth is driven by fiscal stimulus by the US economy. The US labor market continues to remain tight. There are more jobs probably available than number of people who are claiming it, with jobless claims coming down steadily since COVID period. Unemployment rate has refused to go up and remains well below 4%. On the other hand, inflation expectation, while coming down, still remains well above Fed's target range of 2%. The consumer confidence is coming down as burden of higher interest rate is felt by student loan borrowers, credit card borrowers. Housing loans are mostly on fixed basis and hence it won't have material impact on mortgage borrowers. The other side of higher interest rate and work from home is felt on commercial real estate. Today, many parts of Manhattan commercial real estate is available at a price lower than Mumbai real estate in BKC. As Fed maintains higher interest rates, American interest burden is rising rapidly. It has already crossed $1 trillion of interest servicing for calendar year 24, and it could go even as high as 1.6 trillion if these high rates are maintained. The rising interest rates are obviously a reflection of rising American debt. In September 17, total debt was about $20 trillion, and it's almost going to double in 8 years to touch 40 trillion. Currently, debt burden of America is at about $34 trillion, about 125% of its GDP. In this kind of scenario, despite higher interest rate on treasury, household allocation towards equity is almost half of their balance sheet. Debt and cash allocation remains on the lower side compared to equity. This huge investment by households in equity has ensured that American stock market continues to remain elevated. They are today trading at about 18 to 20 forward earnings. However, the rally in American stock market is extremely concentrated with magnificent 7 stocks like Apple, Microsoft, Nvidia doing extremely well. The gap between the highest market cap company and 75th percentile stock is as high at 700 times more as it was before the 1930 great crash. 23, the market cap of largest stock relative to 75th percentile stock is as high as it was during 1930 Great Crash. In that kind of scenario, Indian economy continues to do well. Global institutions are raising their forecast for Indian GDP growth. And on all economic parameters, India continues to be on the positive side. Economic activity remains well above, well into expansionary zone. Capacity utilization is at about 75%. And PMI does give confidence that this number can be sustained. GST collection crossed 210,000 crore first time in April 2024. The GST to GDP ratio now is about 6.9%, well above when it was introduced. The center and state capex remains healthy thanks to the buoyant tax revenues. Global capability centers have emerged as service provider to the world, and it is estimated that about 1,580 GCCs are employing close to 2 million people and generating $46 billion in revenue now. India's service exports continue to grow at a fast pace, while there are smaller nations like Singapore and Ireland which are growing faster than us. We are growing faster than many other peers. In manufacturing, electronics and defense exports are rising rapidly. Thanks to Apple's iPhone production, our electronic exports year to date in Jan were about $30 billion. Defense exports crossed 21,000 crore in FY24. In one summary, Indian economy looks good on many parameters like auto sales, e-way bills, GDP growth, service PMI, power consumption, GST collection, monthly home sales, banking NPA, and so on and so forth. Our GDP growth continues to remain in one of the fastest growing major economic territory, with inflation within RBI's comfort range. The good news for Indian economy is from monsoon. FY23 had witnessed just little below average monsoon, but now it is expected that monsoon will be normal for FY25. We have seen a normal rain after a below normal rain year results into higher food production. Expectation of a bumper Rabi and Kharif crop after normal monsoon in FY25 is riding high. In terms of emerging market peers, India continued to score well above other peer group. There are certain concerns for Indian economy. One is the rural wage growth has remained subdued for last almost a decade. Partly migration shifted from urban India to rural India during COVID. That created excess labor supply, and that resulted into subdued wage growth. This is impacting rural consumption. The recovery is also uneven. Entry-level vehicle sales are declining, but expensive SUV sales are rising faster. In some sense, there are multiple Indias, and that is best illustrated in this chart. About 12 districts in states like Maharashtra, Delhi, Gujarat, West Bengal, Telangana, and Tamil Nadu and Karnataka kind of contributes to 50% of India's GDP. There are 692 other districts which contribute rest of the GDP. The second challenge for India is slowdown in gross FDI from high of about $85 billion in 2022. This year, gross FDI will be about $65 billion. The slowdown on net FDI is even higher than this, as many private equity players have booked profit and taken their money out. If we have to encourage foreign direct investment, then certainly we'll have to create many examples like Apple's iPhone manufacturing in India. Today, 10% of global shipment for iPhone 15 are made in India. How do we replicate this model across many other global manufacturing companies will determine shape of foreign direct investment. Credit growth has remained in double digit, albeit it is coming down from the high 20s into around 16 to 18%. On the innovation side, India seems to be doing well compared to its GDP size. Of course, China and many other Western countries are way ahead of us, and we need to continue to invest for future so that we remain technologically competitive. Artificial intelligence could have material impact on variety of jobs all over the world. Indian IT sector for the first time has retrenched more than 67,000 employees last year. Jobs in IT sector, finance sector, customer sales, operations, HR, marketing are all likely to be impacted with the introduction of artificial intelligence. We will have to ensure that we are leveraging artificial intelligence to provide better, cheaper, and more productive, faster solutions to the world in order to retain our supremacy in IT services. Another challenge for India is geopolitical tension resulting into oil prices going up. As we speak, Israel is announcing invasion of Rafah. Now, could that result into escalation? That to higher oil prices? Who knows? Undoubtedly, higher oil prices are negative for India's rupee rates as well as inflation and growth. One good news about oil price is that OPEC does have spare capacity. Between Russia and Saudi Arabia, they have spare capacity. If Venezuela and Iran and Libya gets their act together with global support, there could be substantially higher spare capacity in oil supply. One good part about India is reduction in India's oil intensity. We now require 40% lower barrels, 40% lower imported barrels of oil per unit of GDP compared to 2007. Coming this broadly positive economic trend into markets, one, for March 24 quarter, the earnings expectations are a little bit muted because of the metal and energy sector dragging down YOY profit growth. We believe PAT growth for Nifty 50 index will be roughly around 4% year on year or about 7% quarter on quarter, mainly driven by drop in metals and mining and energy sector. So far, results which have come out are broadly in line with expectations, with 10 out of 22 results coming in line and 8 coming ahead of expectations in profit after tax. Consumer staples, consumer durables, IT, some of the large private sector banks have delivered results which are below expectations. Pharma, automobile, cement are the sectors which have delivered results which are above expectations. But broadly, the market is giving results which are little ahead of expectations. We believe market or economy is firmly pricing in about 1130 earning per share for Nifty 50 and about 1000 rupee earning per share for Nifty 500. The result season is reasonably decent, and hence there is far less downgrades to earnings estimate in FY24 compared to any other year. Within market, domestic focused economy are likely to be delivering better profit growth. IT, metal, healthcare, and global companies are likely to witness subdued growth. The corporate India continues to remain in solid position. Return on equity is back to about 15%, and leverage has come down to as low as 0.4, 0.5 times net worth. This bull market, if we look at over a longer period of time, continues to remain in a steady state, and it is moving at a nice pace compared to other periods. Our peers are scoring self-goal. Our economy and market both are doing well, and some tight maneuvering by Indian government and regulator is ensured that our weightage in MSCI Emerging Market Index is consistently rising, and we continue to get passive as well as active allocation linked to higher weights in MSCI Emerging Market Index. FPI flows have been erratic. They were sellers in the month of October 23. Then they kind of started buying towards December 23. Again, they were sellers in 1 month, buyers in another month. Their erratic behavior is more likely to be function of how US interest rate expectations have differed and how at various point of time they found other emerging market cheaper compared to India. From a valuation point of view, if we look at, there are certain sectors which are in momentum. For example, infrastructure index led by real estate construction are today trading well above their historical relationship with Nifty indices. Similarly, PSU banks are also in a momentum, positive momentum. Oil and auto index are also in similar positive momentum. All these 4 sectors have done far better than their historical average vis-a-vis Nifty indices. Sectors which haven't done as well is obviously IT, FMCG, and private sector banks. We believe all these 3 sectors provide an opportunity if things turn their way. In FMCG, good monsoon could support rural economy and positively impact consumption and the stocks have been derated. A good monsoon hopefully will re-rate FMCG sector. Private banks' NIMs have come down, but their valuations have fallen more than the NIM contraction warranted. We believe private sector banks again could provide an opportunity of outperformance in the days to come. IT sector has not only not delivered return in last 18 months, but even their results and performance also has been below expectation. If they see volume growth coming back from global markets, certainly IT sector can also see rebound. So IT sector looking for global volume growth, FMCG sector looking for rebound in rural consumption demand, and private sector banks getting support of valuation could result into outperformance in the months to come. This divergence between large and mid and small cap continues to remain elevated. There was a time when top 10 stocks of BSE 500 used to account for 40% of market cap. Today, it is near all-time low at 26%. Nifty 50's market cap as a percentage of BSE 500 is down from 70s to 50s. This suggests that small and mid caps have done far than large cap. The same trend is visible in terms of small and mid cap as a percentage of total market cap. There was a time like 2003, 2008, where small and mid caps were about 18 to 16% of total market cap. Today, they are 37% of total market cap. Undoubtedly, small and mid cap has done far better than large cap. While in many cases there is positive earnings growth, in many cases there is far more PE expansion. We have seen how in microcaps PE expansion accounts for more than 2/3 of return. Market cap to GDP ratio continues to remain well above historical average. Historical average is about 132%. Average is about 80%. So obviously market cap to GDP ratio is above its historical average by a margin. One counterpoint presented by one of my fund manager was that at that point of time, corporate debt to GDP ratio also was high, and hence enterprise value of India, which is equity market cap plus debt, was also on the higher side. Today, corporate debt to GDP ratio has come down reasonably, and hence, if we look at enterprise value, then the impact will be slightly lesser than what is visible in this picture. From a valuation point of view, large caps trade at about 6% premium to historical average, mid at about 29% premium, and small cap at about 38% premium to historical average. One of the reasons why Nifty could be trading at a slight premium to its historical average is the change in the composition of Nifty stocks from low PE ratio government companies. There has been more inclusion of high PE ratio private companies. From domestic companies, have seen their value going up in indices compared to global companies. And B2C consumer companies' weight in indices have gone up higher compared to low PE, lowly valued B2B. In some sense, Nifty's current 6% premium is justifiable. Looking at changes in Nifty 50 pattern, which is tilting towards private companies, domestic focused companies, and B2C consumer companies, which has traditionally enjoyed higher P/E ratio. Our outlook on market continues to remain the same: neutral weight to equity, overweight large cap considering risk and reward, marginal underweight mid cap, and book profit to become underweight in small cap. What we have been recommending is also practiced by us in our Kotak Balance Advantage Fund and Multi-Asset Allocation Fund. Their equity allocation continues to remain in the middle range, the neutral allocation. Depending upon events, when does Fed start cutting rates? Will we get Modi Sarkar as priced by the market? Will energy prices continue to remain around 80 big figure despite Israel's invasion of Rafah? Will consumption recover with monsoon? Will there be geopolitical event like China, Taiwan, Russia, Ukraine, Israel, Hamas? All those things will have an impact on our market. If this events turn favorable, there is room for market to go up. If this events turn unfavorable, there is room for correction in the market. One reason why we have to be very, very careful about valuation. A perfect example is Zoom. In COVID time, Zoom shares started zooming up and they were all touching sky in terms of valuation. In 2020, the peak valuation of Zoom was about 124 times sales. Their sales have increased 10 times between 2020 and 2024. However, the valuations have corrected significantly. Now, price to sales ratio for Zoom is just about 4 times. Investors had lofty expectations for Zoom, willing to pay 124 times sales at October 20. And despite 10x increase in revenue, the valuations have come down to normal 4 times price to sales. In the current environment, next slide, please. Next slide, please. SIPs have continued to add value to our customers. This is rolling return SIP alpha generation over some of our equity funds. This is similar rolling return SIP alpha generation over equity and hybrid funds. This is point-to-point alpha generation across our equity funds, where some of the small and mid-cap funds haven't done as well as expected. This is point-to-point alpha generation across various equity and hybrid fund. Across most of this fund, over 3, 5, 7, 10 years and since inception, we have added value to our customer. This is the SIP return, again bearing small cap and mid cap fund, where SIP alpha generation have not been as per expectation. Rest of the funds have delivered reasonably higher alpha. This is the alpha generation of SIP across other debt and hybrid funds. Kotak Multi-Cap continues to invest across small, mid, and large. As of today, like our recommendation, it is biased towards large cap with about 50% allocation and 50% allocation in small and mid cap. Since inception 2.5 years ago, it has delivered about 8% alpha extra return over benchmark indices. Kotak Equity Opportunities, which is blend of large and mid cap, again is Harfan Maula fund. It has delivered consistently alpha or excess return over benchmark indices since its inception. Kotak India EQ Contra Fund again is another fund which takes counter or contra bets to the market. And over the last 5 years, it has delivered about 4% alpha. Quant Fund is the latest baby in our offering. It combines man and machine together. While the boundaries are defined by our research team and fund manager, we use quantitative techniques to build portfolio. It is built on momentum as well as quality. Since inception 7 months ago, it has delivered alpha of about 26%. That's a reasonably strong performance in today's market, and clearly what we had practiced in our laboratory for more than 2 years, we are very happy to see that yielding result in real market in last 7 months. Another sector where we continue to remain bullish is pharma. We did launch Kotak Pharma Fund a couple of months back, and this was primarily driven by very high drug shortages in US, which is at all-time high. We believe US government will do stockpiling of pharma products, and hence the Indian companies not only will get higher volume, but also higher value. Kotak Pharma Fund is available across multi-cap, large, mid, and small in pharma sector, and between healthcare, insurance, and pharma companies, it is a well-diversified portfolio. Coming to debt markets, US inflation is easing. The rate cut expectations have been deferred from 3 rate cuts in CY24. Now expectation is about 1 rate cut in CY24. The US Treasury yields had bounced back in recent times. Indian inflation has also moderated, especially at core CPI. Core CPI is now well below RBI's target range. The liquidity situation turned around since mid-23. There are days when it is negative, there are days when it is positive, but RBI is managing liquidity very, very nicely through VRR and also buyback of bonds announced just last week. While interest rates have inched up in recent time, we still think this is time to accumulate duration, time to accumulate long maturities over a period of time. Depending upon whether budget sticks to vote on account fiscal deficit, general election result, US Fed pivot, and the buying by FPIs in debt market will determine whether 10-year GSEC goes higher or lower. We believe on an 18-month view, longer interest rates are likely to be cut, both policy as well as market, and hence it is time to go long duration. On the debt investment side, Deepak continues to manage dynamic bond fund very nicely. It continues to add value to our investors by outperforming illiquid benchmark indices. Even hybrid funds can also provide good opportunity for investors looking to seek comfort of debt and slightly higher return. Kotak Equity Saving continues to do very well, and so is Kotak Multi-Asset Allocator Fund of Fund. This hybrid funds could be ideal product for investors who are looking at slightly higher return and slightly higher volatility. Kotak Equity Savings combines benefits of debt arbitrage and cash equity. It gets equity status from a taxation point of view, and it is delivered most of the time positive return on a 3-year rolling return basis. Kotak Debt Hybrid Fund is about 75% debt and 25% equity. And look at the consistent alpha generation of Kotak Debt Hybrid Fund over last decade plus. We have been bullish gold since March 20, bearing 2021, where gold delivered negative return. We continue to remain bullish on gold. Our bullish call on gold is driven by central bank buying led by China in gold. China has been accumulating gold, probably with a view on Taiwan, and their buying is resulting into gold prices getting higher. Along with China, other central bankers are also continuously buying gold, and that probably is explaining why gold prices have run up in recent time. Clearly, we are seeing that gold is scoring over diamond from a savings allocation point of view. Lab grown diamonds are impacting real diamonds. There is no lab grown gold, and hence gold continues to get preference in an Indian's portfolio. Finally, gold prices do get supported whenever Fed cuts rate. This year, Fed is unlikely to cut rates, but how long they can defer with $34 trillion of debt. As and when Fed starts cutting rates, there will be another bullish cycle in gold. The silver production has come down, especially in Latin American countries like Mexico and Peru. Both these things will also support silver prices, lower production, and higher demand.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.